a 1% interest rate, you can afford that much more home. So this is the real fear in the housing market or the investment market right now that I look at on the housing side, is that inflation will cause rates to go up. People will be able to afford less. Therefore, there'll be less buyers in the market. Inventory will go up. And that's what will cause, in my opinion, the housing market to slow down or to get into some issues. Hey everyone, welcome back to the Mark Loeffler Experience. We got, I think, the most fun show we've ever had. Yes, we're going to talk interest rates. All interest rates, all the time. That's all we're going to talk about. I mean, am I the only one that finds interest rates this exciting? This is basically the cat's meow for me. I'm just going to put it out there. This is my nirvana. This is what I just love to do, is talk interest rates with you guys all day long. Comment down below. Let me know what you think interest rates are going. Definitely smash the like button for my interest rate talk. Let's see if we can get the interest rates. Like for interest rates, 1,000 likes. That would be amazing. Make it happen, everybody. All right, let's talk about that. What is a negative interest rate? Are we going to see it here in North America, Canada, US? What would that affect? Where do they have negative interest rates right now, and what does that look like? And there's been a lot of talk lately about negative interest rates because obviously we're in this pandemic, and negative interest rates would basically cause people to spend money because the bank actually charges you money to have money in the bank. So in Europe, for instance, like you're paying 0.5% a year to have money in the bank. So you have $100,000 or more in the bank, then you have to pay the bank to have it there because it costs them money, because every deposit they get, they have to pay the central bank to hold some of that, and that costs them money. So banks are not in the business of losing money. This is not what they do. This is not why they exist. They do not lose money. So therefore, they collect it from us. They get collected from people who have bigger bank accounts, corporations, wealthier individuals who are going to have money sitting there, and that would either go spend it or invest that money elsewhere. And that's what the hope of negative interest rates is. They've had it in Japan for a while. They're doing it in Europe right now. I don't think we're going to see it in North America. Both Canada and the US, the Fed and the Bank of Canada have said that they don't feel that we need negative interest rates. And I would say that the bond market is telling us right now that they're correct. And what does the bond market have to do with the interest rates? Well, at least the prime rate that the Bank of Canada or the Fed set. Well, nothing technically, yet that is their trigger for how they fight inflation. If they think inflation is going up, they raise interest rates. We've already talked about the Bank of Canada in video last week, in which we'll link down below if you want to check that out, in which they basically said they're not going to look to raise the prime rate until 2023. For us investors in Canada, it's the 5-year bond rate that affects mortgages most often, because we have adjustable rate mortgages that come up basically most of us, 5-year terms. In the US, it's basically based off the 10-year Treasury bill. Bond yields are rising. So they're basically up 50% from the beginning of February to the end of February, at least in Canada. So they went over 1 in Canada for the 5-year, and they're back down just today around 0.82, 0.84. In the US last week, they went up to about 1.5. It's now around 1.4. So it went up to 1.5, now it's down 1.4. But if you go look at this thing, the low, basically, obviously not like the low in the beginning of COVID, it basically went to half. In August again, it went to about 0.5%, and it's been steadily climbing ever since. But the beginning of February, is around 1%, actually closed at 106. So that's a significant increase in a month. And so why are bond yields going up? Why are mortgage rates going up? It's because people think there's going to be inflation. Obviously, if you guys have watched myself and Andrew on here, we talk about inflation being inevitable. If you look at, say, oil, it's approaching its highest mark since 2018. Copper's at an all-time high. Sorry, 10-year high. Most of the commodities, they're off their 50 to 60% above like their lows type thing. So it's like they're going like, I don't know if you tried to buy a 2x4, but it's kind of 3 times the cost it was, right? What does all this interest rate talk have to do with us? What does it have to do with real estate investors? What does it have to do with a homeowner? What does it have to do with a stock market investor? These are all legitimate questions, right? For an apartment building buyer, I'm going to sell based on a cap rate. Capitalization rate, basically net operating income divided by the purchase price gives me the cap rate. All that cap rate is a determinant of is the cost of borrowing. So the difference is between the cost of borrowing and the cap rate is basically my yield, is basically my return. And what these low interest rates have done is they've really compressed cap rates in the, at least Ontario and in other regions, out in the Maritimes, for instance, the US, the same thing. They're compressing cap rates because if I can get a 1.5% mortgage on a 20-unit building, then I'm more than willing to pay, a 3.5 cap, a 3 cap. I mean, I've just sold some of my buildings for under a 3 cap because, they can get a dirt cheap mortgage on it and they can renovate and get higher yield on the building. We talked about it in the mortgage thing where, a 1% interest rate, you can afford that much more home. So this is the real fear in the housing market or the investment market right now that I look at on the housing side is that inflation will cause rates to go up. People will be able to afford less. Therefore, there'll be less buyers in the market. Inventory will go up. And that's what will cause, in my opinion, the housing market to slow down or to get into some issues. Do I think that's going to happen in 2021? Well, we're already seeing fixed rates mortgages go up a little bit, but this is all tied to the 5-year bond yield and it fluctuates. Already down off its high, like it went above 1% in Canada and now it's down to 0.8 again today. You can kind of time when you lock that in on your purchase side, right? Like if you're buying your single family home, I know I'm refinancing a property and I basically locked it in like not too long ago and I can always change it to the lower rate, but they can't change it to the higher rate. Basically last week, we talked about this a little bit on the video on Friday, why stock investors are starting to really worry about rising bond yields. It's basically inflation, right? So if there's inflation, again, inflation is the problem here. The Federal Reserve may shift their policy. So they've said, again, like the Bank of Canada, 2023 is when they're looking to raise rates again because both of them have said they want to get past full employment. They want to make sure employment is ramped up. So the employment's ramped up and it's all gone through and it's strong. So if they go ahead and raise rates, which they will do at some point because they can't stay this low, then it's not going to affect the economy because that's what their concern is. And in the US and in Canada, that would shift how many bonds they're buying, right? Because that's what they do is they're buying bonds right now to artificially keep the rates low, as well as raising the prime rate. And obviously that's negative for stocks because that means that these companies can't borrow as cheaply. And if they can't borrow as cheaply, they're paying higher interest rates. They may not be growing as fast because, they borrow money to grow and then they're doing something different or, if they're triple B or whatever, then they're paying, 6, 7, 8% rather than 4%. Again, we go back to that mortgage chart, we can see the lower interest rate allows you to buy that much more home. It's the exact same for a corporation. So they can borrow more money, cheaper, and then be able to grow and invest that into different things. For instance, you look at something like Tesla. Obviously, they're borrowing to build gigafactories and to hire workers and to be able to go out there and grow. The Fed has obviously come out and said, and the Bank of Canada has said they've come out, they're saying that inflation, the broad signs of inflation have not been present in the real world. And they're calling it transitory. So they're saying that it's a supply shock. Stuff will, like lumber will come back because we're going to get more supply. Once we get more supply, it will lower the cost. The supply shock to oil was cold weather in Texas. They can't handle that. Stuff broke. So therefore, basically they stopped either pumping oil or refining it. So obviously refined oil went up. Who's right, the investors or Powell? Because this is very important. Because this lets us know whether we lock in now, whether we take a shorter term, or are we sitting investing in the stock market, or are we just sitting on the sidelines waiting for the crash? Same thing on the housing market. Should I rent now and buy later? Well, obviously it depends who you ask, right? Obviously consumer inflation super low, the CPI, how they calculate that, and this is how they watch it. So there's two sides to the coin here, obviously, right? So who's right? Well, consistently we've seen economists be a lot more pessimistic, say. So, for instance, Bank of Canada forecasted that the economy in the fourth quarter would grow at 4.7%. It actually doubled that. It grew 9.4% in Canada in the fourth quarter. This is super robust. Still, in September, in say January, February, we saw that they came out and they're still talking 2023. So here's what I'm going to tell you. I'm going to moderate in the middle. I don't think we're going to see huge run up in rates right now. I think the economy is going to grow quicker than they think. And I think that 2023 is a super conservative estimate. Would I be surprised if they started raising rates in 2022? I would not in the least, because I see the signs of inflation, the commodity pricing, and even though they say, well, it's a commodity super cycle, these things will come down, maybe, yet I think they're underestimating how much we're going to grow. I think we've been depressed. I think when everybody gets the jab, people are going to get out there, people are going to spend money, people are going to go on vacations, people are going to go to restaurants, people are going to go out to the ball game, people are going to go out. People are just sick and tired of being inside for the most part, and people are going to go out. The economy is going to grow. Jobs are going to come back, and this is what they're talking about, is they want to see 3 to 6 months worth of solid jobs. I think they're going to see that in 2022. So I think the Bank of Canada may change their tune, and we may see some interest rate rises in the third to fourth quarter of 2022. That's the prime rate. Now, the bond, again, that is investors saying that the big investors saying that they're fearful of inflation and they're rotating out of stocks into bonds. These are some pretty smart people, and I'm not going to bet against them. I'm not going to bet with them, because I think we're going to have a little bit more of a run here. That's just my opinion. I am betting with my own money. I'm not betting with yours. So whatever you decide to do, definitely do your due diligence and make sure you're educated. But that's what I have to say about interest rates today. If you agree with me, comment down below. If you disagree with me, comment down below. If you had no idea what I talked about during this whole thing, comment down below. Thanks, everyone. We'll see you soon.